Okay, hello everybody. I'm Leah College, the director of Real Wealth Realty. Real excited to be with you guys today for an education class. We are joined today by one of our preferred sponsors here at Real Wealth, Hall CPA. I've got Thomas Castelli on the line with us here to nerd out about taxes. Everybody, well, most people are familiar with the tax incentives that come with being a real estate investor, but few people are as strategic as they should be to prepare for some of that tax saving. So, Thomas has prepared a presentation today for us to kind of jump into some of the tax strategies that passive investors like us here at Real Wealth should be leveraging as we build our portfolios. So, Thomas, thank you so much for joining us this afternoon.
Thanks for having me. It's a pleasure to be here today.
I would love before we jump in, if you could kind of tee up for me just high level, what does Hall CPA do for investors?
Yeah, absolutely. So, Hall CPA, we work with real estate investors across the country. We work with individual investors, small partnerships, syndicates, and funds, and we help investors reduce taxes through strategic tax planning. We help file tax returns the right way the first time. We see a lot of mistakes out there on tax returns, so we take great pride in making sure it's done right. And we also offer accounting services. So at the end of the day, our goal is to help real estate investors better understand the tax code and utilize the code to their advantage to reduce their taxes. That's our goal.
I love it. So, people watching today, you might be able to take some of the tidbits that Thomas teaches you today to your own CPA, but many of you have probably outgrown your tax preparer, and you might not have a tax strategist at all helping you really think forward about how you can plan. So, Thomas will share some contact information for Hall CPA towards the end of the presentation in case you are looking for that tax advice and looking for a tax preparer who truly understands what it is you're trying to do with real estate, making sure you're not leaving money on the table, as so many investors likely are. So, Thomas, if you can advance to the next slide for me, I've got a quick housekeeping item, and then we'll jump into today's presentation. Okay, so we love when you guys are on live with us because we can be interactive. I'll be monitoring the Q&A panel on the Zoom control panel there. So if you're on here live now, pop open that Q&A panel so you can send in questions and I'll feed them to Thomas as we go through the presentation. If you're interested in joining us for our upcoming live webinars, next Thursday, we're going to be talking with our Indianapolis team. They specialize in awesome turnkey renovated property, and they also have some new construction multifamily developments. We'll be talking to them next week. And then the following Thursday, we're going to be joined by our Chattanooga team, another rehab team, one of the newer teams to Real Wealth, but man, really impressive one. So we'd love to have you on those. Registration for those is up on the portal, so you can scan that QR code there, or you can go to events when you're logged in and you'll see the webinar schedule to register. Okay, that's it for my spiel, Thomas. I'll let you jump right in. And then, like I said, if I see some questions come in while we're on a relevant topic, I'll interject.
All right, so we're going to go ahead and get started. So, kind of like what Leah said before, we're going to be covering the tax benefits of real estate. For some people who are new to real estate, this may be eye-opening, and for some of the vets in here who may have been in the game for a while, it's going to be a good refresher for why you're in one of the best asset classes from a tax perspective. So. We'll start with a quick crash course on the U.S. tax system. I promise I won't bore you. It's going to take like 2 minutes, but it's really going to help set the stage for understanding the rest of the presentation. We're talking about shifting earned income to passive income and how that is beneficial from a tax perspective. We'll talk about using real estate losses to offset active income. I always get a lot of questions about that, so we're going to cover that as well. And then also tax efficient investment and exit strategies can really help you maximize the tax benefits of investing in real estate. So let's go ahead. A quick disclaimer. This is for informational purposes only. Please don't go run out and immediately apply this to your situation. Please do consult your own tax professional prior to doing so, just in case something is not applied correctly to your situation. Okay, so that's it. That's it there. Now, without further ado, here we are. So if you have a job or a business, like most people do, you earn income from that job or a business is called earned income. We'll just call it that going forward. This is taxed at the federal tax rate of up to 37%. Right. Then you're usually going to have state taxes unless you live in a state that doesn't have any state taxes of up to 13.3%. That is the California state tax rate. It's the highest, I believe, in the country. Plus, you're also going to have FICA taxes, which is Social Security and Medicare. If you do have a job, that's 7.65%. If you do run your own business, you are blessed and you get to pay both sides of that tax. So 15.3%. And if you live in some locations like New York City, for example, there could be local taxes. So it's not uncommon to see high income earners, if you're making lots of money, hundreds of thousands of dollars, millions of dollars per year, to pay 40 to 50% of your income in taxes. I see it happen all the time, especially in states like New York and California, but it could happen anywhere. And it's painful. It's painful to watch because at the end of the day, it's very challenging to reduce taxes on this source of income. You have retirement accounts, you have charitable contributions, you have your standard deduction, you have your mortgage interest, but and a few other little odds and ends. But at the end of the day, that can only do but so much for you. So this is where starting to see where real estate kind of fits into your situation is going to be beneficial. So here's the best way I could show you is kind of through a little bit of an example. So let's just say that you're paying 40% taxes all in, just for the sake of argument here. Every additional dollar you earn, 40% of it disappears. You're gonna have to pay the tax authorities, right? So if you made an additional $100,000, $40,000 of this is just gonna vanish. It's gonna be gone. Can't do anything about it. Well, you might actually have to pay, you actually have to might pay them, but it's gonna go to the tax authorities either way. But with real estate, there's a non-cash expense called depreciation. Now, depreciation often creates a loss for tax purposes, meaning you're telling the IRS that you lost money and the other tax authorities, despite the fact that you might actually be generating positive cash flow. It's not uncommon to see that happen. So that's the benefit of like one of the first benefits of investing in real estate is being able to use this non-cash expense to shelter your income, your rental income from tax. Because rental income at the end of the day, rental income is also taxed at 37%, right? If you have net rental income. But by being able to use depreciation, you are eliminating that. So to kind of give a little bit of more of an example here to flesh this out a little bit more, let's say you generate $100,000 in income from your rental properties. Most of the time, you're going to have operating expenses. Very rarely, you're going to operate a property with nothing, with no operating expenses. So let's just say it's $45,000. You're a pretty good operator. You keep within that 40 to 50% range. And some of these expenses are property taxes, management fees, utilities, things like that. This is money you have to pay a third party. And this will leave you with $55,000 in quote unquote net income. I know it might be a little different for any tax nerds out there that, but for the sake of purposes, you have $55,000 in net income for the sake of this conversation. In most cases, you would pay taxes on that $55,000. And again, if you're a high income earner, it could be 40% or more, which is $22,000 or more in taxes. Okay. Oops, I went too fast with the slide. But let's just say you have a non-cash expense of $60,000 from depreciation. And in this case, you would have a tax loss of $5,000. So you have your taxable income is negative 5,000, right? So you have tax loss, you're not paying any taxes on your rental income, even though you've generated $55,000 in positive cash flow in this example. So that is kind of the first benefit I want to highlight of investing in real estate is the fact that you can generate cash flow again without paying taxes on it. All right. Now the next question. Okay. Well, before I was going to go right into how it can help you, like how that loss is used. But I do want to hammer this point home because I work with a lot of investors who sometimes they hear about the benefits of being able to use losses to offset your W-2 income or your business income. And we're going to talk about that here. But I want to show you how this actually does help you reduce your taxes. So this is an example. If you're a single taxpayer, if you reside in New York City, you have an annual income of $500,000 between federal, state, local, and FICA taxes. You would typically pay around $214,000 in taxes, resulting in an effective tax rate of 42.86%. So your effective tax rate is the total tax you're paying divided by your total income. Or in this case, we could look at it as cash flow, right? Because you have negative income on your rental properties, perhaps, but your total cash flow, that's going to be your effective tax rate. All right. So If you were to earn an additional $55,000, let's say through W-2 income, you'd face an additional 26.5K in taxes, pushing your effective tax rate up to 43.38%, right? So not the most efficient. But let's just say that you're able to generate this $55,000 from rental properties, right? Now, this is tax free. So your income is increasing, but your taxes aren't. So this is actually decreasing your effective tax rate to 38.61%. And if you had $100,000 in tax-free income from your rental properties, it's now decreasing your effective tax rate even lower to 35.71%. So I'm just trying to drive that home that even without any of these other crazy strategies that we'll get into, or some of these other lucrative strategies we'll get into, just by investing in rental real estate and sheltering it from tax thanks to depreciation, which you have to take, the IRS requires you to take it, is helping you decrease your effective tax rate and in effect decreasing the amount of taxes you're paying. All right. So next question is what happens to this loss, right? So great, we sheltered our rental income from tax, we're decreasing our effective tax rate. But now in this example, we have this $5,000 loss. And in many cases, it could be bigger than $5,000. I'm sure some people on this call have experienced that. So as a general rule, real estate is passive, and this loss cannot offset your W-2 or your active business income, right? So if you were making $500,000 from your W-2 job, you're not going to take this $5,000 or perhaps much larger and just use it to offset that $500,000 and reduce the amount of taxes you're paying on your W-2. Unfortunately, that's not the way it works just off the bat. And we'll get into how to do that. But instead, this loss is going to be suspended and carried forward, and can help you offset rental income in future years. Okay, so this loss does not get lost, right? It does not go away. It simply gets moved to the next year. And at some point in the future, you're likely to have positive rental income, or you may have positive rental income, and that can help you. Or when you sell a property, if you sell a rental property, this loss can be used to offset the capital gains in future years. So these passive losses are valuable, and you definitely don't want to overlook them.
This is why I always tell my clients before they jump on the 1031 exchange wagon, which I know you're going to talk about briefly here. I always tell them, talk with your accountant first and make sure you don't have losses carrying forward that would make the 1031, not applicable for you, where you could go ahead and sell and then take the losses to offset the gain on that sell. That I've had that happen with a sale of one of mine. It's certainly easier to reinvest that capital when you don't have the 1031 exchange timelines breathing down your neck.
Absolutely. They call that the lazy 1031 exchange. Has kind of been coined by people
Okay.
out there, and it's basically when if you have enough passive losses that you've accumulated throughout the years, you may not need to use a 1031 exchange when you sell because your passive losses may be enough to cover most or all of that capital gain. Or, excuse me, what you can do is you can invest in another property in the same year that you're selling your property, run a cost segregation study, use bonus
Hmm.
depreciation,
Yep.
and use it to increase your losses. So these passive losses are extremely valuable, and that's really what I'm trying to drive home here is that if as a passive investor, there are substantial tax benefits.
Yep.
Okay, so all right, so we kind of just went through this, but I'll recap it here. Basically, use the losses from other properties that you have or you accumulated throughout the year to shield your rental income from tax. It can help you reduce or eliminate taxes on the sale of your property. Okay. Next, we're gonna have shifting. Okay, so this is another thing I do want to highlight, which is shifting your earned income to passive income. This is a mindset, right? So you have your income from your job or your business that allows you to invest in real estate. And over time, as you begin to accumulate properties and your cash flow increases from your properties, you are going to continue to reduce your effective tax rate. And I put this in here so much because I've talked to so many investors so focused on other aspects of the tax benefits that this is overlooked. So again, if you invest in real estate, you generate cash flow, you can shelter it from tax through depreciation. In the long run, you're going to help reduce your taxes by reducing your effective tax rate. Okay. Now, real estate professional status. This is a question. This is something that we get asked a lot of questions about, which is why I included it in here. If you remember what I mentioned before, losses are passive by default and can't offset your W-2 income. But if you qualify as a real estate professional, then the losses from your rental properties will be quote unquote non-passive and then can be used to offset your W-2 income. So to give an example, we'll go back to our 500K example from before just to keep it consistent. And we're going to increase our depreciation expense a little bit. Let's say it's $50,000. And yes, that is very possible thanks to cost segregation, which I'm happy to touch on at some point. Um, uh, Now you're only going to be now, so you have your taxable income of $500,000 from your job. Now your $50,000 loss from real estate. Again, normally that's not going to be able to do anything for you, but if you qualify as a real estate professional, that $50,000 will reduce it down to 450. And now instead of paying tax on $500,000, you're paying tax on $450,000, which can result in substantial tax savings. However, in order to qualify for the real estate professional status, you spend more than 750 hours, and this is the kicker. This is the one where prevents a lot of people from qualifying, and more than half your total working time. Okay, so if you have a job, you are most likely not going to qualify. I cannot qualify for this, so I'm in the same boat. If you're in this boat too. Um, if you have a job where you're actively participating in a non-real estate business, getting over this half your total working time hurdle is challenging. The reason for that is the IRS looks at a full-time job as 40 hours per week. So that's 2,000 to 2,080 hours per year. And to get over eight, in order to spend more than half your total working time in real estate, on top of that, you have to be working 2,081 hours or more in real estate. So you're talking about working like 80 hours a week, right? Every week of the year. And the IRS knows it's virtually impossible. So it's a big audit red flag for them. And then there's dozens of tax court cases with taxpayers who are in that situation, who tried to qualify, thought they could beat the system here and ended up losing. A very, very, very common mistake is
Mhm.
to try to qualify for this. And I'm not trying to scare anybody here. I'm just trying to lay it out because this is what we see. We see it happen all the time. So if you can meet these requirements, then again, your loss will be non-passive. Now, here's one common strategy we do see people use who do want to use this. It could be that maybe you're a high income earner, or maybe your spouse is a high income earner, and maybe you work part time or you don't work at all, and you can take over the responsibilities of the real estate side of your life, I guess you could say, or your business operations, and will allow you to qualify as a real estate professional, and you both benefit as long as you file a joint return. So we see that happen often. This is a very common strategy. So this is just a little bit about the real estate professional status.
Thomas, I have a question about that. I've heard it said before that the IRS might be suspicious also if you're claiming rep status and you're using professional property managers, or maybe that even the number of doors that you have could be kind of a red flag for the IRS. What are your thoughts on that?
Yeah. So in the IRS Audit Techniques Guide, also known as the ATG, it's the field guide they give their auditors when their auditors are auditing people. And one of the major red flags is if you're using a property manager, you are most likely not materially participating, meaning you're not spending the type of time that would so they call it being involved in the day-to-day operations of the property. And in order to these hours that you're getting here, if we're just talking about a rental portfolio only, I would have to come from basically operations or managing. So if you have a property manager, you're effectively delegating those tasks, those responsibilities to the third party property manager, and therefore you would not be able to meet these requirements. So that is a major red flag. Because again, a lot of the things that do count, if we were to drill down into this a little bit more, we're talking about showing the property for rent to tenants, right? Like the walkthroughs and negotiating leases and performing repairs or coordinating repairs, advertising the property, doing things of that nature. So that's stuff that your property manager will do. So that's a major red flag. So if you're using third-party property management, a good chance that you probably wouldn't qualify, and it could be an audit red flag. Additionally, the other thing I forgot, the other thing you mentioned again, the other red flag that you mentioned.
Was about the number of doors maybe being a
Oh,
giveaway
yes.
too.
Yeah, so there is no statutory rules on the number of doors, right? You could qualify, and people have qualified, and won tax court cases. There's at least two that I'm aware of that people qualify with as little as one property. However, um, there's a lot of work that has to go into 750 hours on one property, and it's challenging. And we've seen people do it, and the situations where we've seen people do it is where there's a tremendous amount of work involved with the property and ongoing maintenance, and it's just it's not very common. I would say it's the exception. So usually, the more properties you have, the stronger your position to qualify.
Hmm.
But if you have one property, I would say it's challenging, but not impossible.
Yeah. I mean, I'm thinking about the implication of our client. I mean, most of our Real Wealth members are acquiring property long distance, right?
Yeah.
So they have to use property managers on the other side of the country, but maybe they've amassed a large size portfolio. So how could I'm sorry to drill down on this, but I know this is a question a lot of our members have. How
Mhm.
could they realistically meet the rep status using property managers with a portfolio that's long distance?
Yeah, so we believe so it is possible to manage properties from a distance. There's tax court cases that have proved that it's possible to basically materially participate is the technical term for it
Hmm.
in other businesses from a distance. So that's kind of been proven now after COVID. It's definitely been proven possible. However, with larger portfolios, to address that question, we don't really see too many task court cases or challenges on those issues because it's the spirit of the law, if you will, is that you're a real estate professional. You're in this business full time. This is what you do,
Hmm.
and as your primary occupation. And when you have a pretty large portfolio, even when you are using property managers, there's usually a lot of things that you have your hands in that are
Right.
material to your overall operation. Right. So a lot of times when we see challenges on this, whether it's from the IRS or in tax court, it's on when people just have just a handful of properties, to your point before, um,
Hmm.
uh, or or they have full-time jobs or businesses that they're running. So to answer your question, I wish I had like a clear answer. We've been searching for one, but there's just a lack of challenges and a lack of tax court cases when you get to these higher these larger portfolios, and we believe the reason for that is that there's just so much coordination going on
Hmm.
between you, your property managers, and just your level of involvement in the business
Yeah.
it becomes so much less risky.
Yeah, I appreciate the extra time spent on this. And I don't want people watching to be discouraged if you're now going, you're dashing my reps' dreams, because all of the other benefits that Thomas is talking about today are applicable to us passive investors. So, but I do appreciate you kind of elaborating a little bit on this slide.
Anytime. All right. So now we're going to jump into the short-term rental quote unquote loophole. Okay. So short-term rentals, there's an exception in the tax code. So again, mentioned this before, all rentals are passive by default. But back when these laws were written in the 80s and 90s, there was an exception to the definition of rental activity, and that exception is if your property has an average stay of 7 days or less, or 30 days or less, and you provide substantial services like daily cleaning, daily meals, concierge tours, things that like of that nature. These rules were designed for hotels, right, and motels and similar businesses. So as you can imagine. Um, in the 80s and 90s, I don't think that the tax code that the people who the lawmakers, the Congress who put this together probably foresaw Airbnb and VRBO coming to light where you could just go on your phone and list your property. There's obviously a little bit more work involved in it than that, but just listing your property and being able to do 7 days or less. So today, if you're able to do that, you're able to have an average period of customer use of 7 days or less, or the 30 days or less with substantial services. You're now in a business. You're not considered a business. You're not considered a rental property anymore. And as a business, businesses are not passive by default. If you materially participate, and I could break down what some of those rules are. If you materially participate, your losses from your short-term rentals will be non-passive without the real estate professional status. So to give you just some additional insight into material participation, there are 7 material participation tests. You only need to pass one of them. We're not going to go through all of them. We'll go through the top three, the three that are most relevant to the majority of real estate investors. And the first one is you spend more than 500 hours managing your short-term rental. We rarely see that with short-term rentals, to be honest, but people have done it. The second one is you do substantially all of the work. Um, So that means you're pretty much a one-person show, very little to no third-party help. Or number three, which is definitely the most popular one out of the three, you spend more than 100 hours, and no one else spends more time than you. Or stated another way, you spend more than 100 hours and more time than anybody else. And if you beat these two requirements, your losses are non-passive and can offset your active income or your earned income on using this strategy. So, one thing I do want to note here, the real estate professional status, and I should have mentioned this before, the real estate professional status, that's 750 hours and more than half your total working time has to be entirely met by one person. So if you're married, either you or your spouse have to meet that. You cannot add up your hours. One person cannot do 325 and the other do 325. It doesn't work like that. However, with the real estate, with material participation, both hours of both spouses, the couple are combined as one person. So it is possible for you to spend 55 hours and your spouse to spend 60 hours and be more than 100 hours. As long as no one else works more time than you two combined, then you can meet this requirement. So that's short-term rentals. This only applies to short-term rentals. So if you meet this requirement, your losses on your long-term rentals will still be passive unless you do qualify as a real estate professional.
Yeah, super powerful strategy. I actually tested this one out last year and reduced my taxable income $100,000. Had some great benefits from this, but I always stress to my clients that I speak to who are hearing of these strategies that this is tax savings well earned, in my opinion. It's not fake hours by any means. I mean, it's a totally different business than what we ordinarily do here at RealWealth. You're very much actively involved, setting up your Airbnb and managing it. And I mean, to your point, Thomas, I was meticulous about tracking hours
Yeah.
of all of my cleaners and myself, just to make sure that we were completely audit proof. But it does work. This is a really incredible strategy.
Okay. Yeah, no, I love it. It's very popular, still popular today, but we're going to move it right along. So, accessing your home equity tax free. Here's yet another major benefit of investing in real estate. So, as time goes on, we know that in most cases, real estate tends to appreciate in value, right? Again, we're depreciating our property, we're taking that depreciation expense, but it's actually often appreciating in value. Also, you're going to be paying down if you leverage your property, you use debt to purchase your property. As you pay down your mortgage, the principal, your equity also increases, right? So equity increase from appreciation, equity is also increasing from paying down your mortgage principal. So and now there's some ways to tap into your equity, right? You could do nothing. You could just let all that equity sit there in the property and do nothing with it. There's nothing necessarily wrong with that. Or you could sell your property. If you sell your property, you'd be subject to capital gains and depreciation recapture taxes, and maybe use a 1031 exchange to mitigate it, which we'll talk about. But then you don't have the property anymore. It's gone. So what if you want to keep the property, right? You don't want to sell it to tap into that equity. Well, you could use a cash out refinance or a HELOC or a line of credit. Basically, you use that property as collateral. Real estate's often one of the best forms of collateral to obtain loans. And you can tap into that money, get cash out tax free. And the reason why it's tax free is because loan proceeds are not tax deductible, excuse me, are not taxable income. So you get the loan, you can go use it really for whatever you want. However, if you do use it for business purposes, such as down payments or towards rehabs on other rental properties or towards whatever expenses within your business, then the interest is also remains tax deductible as well. So another perk. Quick side note, you can also use this on other assets too. You can also pledge stock accounts. It's how Elon Musk actually, believe it or not, bought Twitter, was he pledged his Tesla stock and did a cash out refinance on his stock and bought Twitter. So this is just another big benefit of real estate investing, and again, other forms too. Okay. Went too far. Okay, deferring capital gains taxes. Okay, now if sometimes you have to sell your properties, you can't keep them all forever. And when you do sell your properties, you if you use a 1031 exchange, you can defer your capital gains taxes and depreciation recapture. If anybody's questions on that, more than happy to talk about it. By investing the entire sales proceeds into your next property, and you continue to build your portfolio and grow your wealth. To give an example, if you were able to save $100,000 in capital gains taxes, this would unlock $400,000 in additional purchasing power if you were to use a 75% loan to value ratio, which is relatively common, I would say, and especially in the 1 to 4 unit space. So this is just something you could do over and over again, right? So you can do a 1031 exchange on property A into property B, hold property B for usually it's at least a year, and then you could 1031 exchange into property C, and you can just keep kind of doing that. Now, the downsides of 1031 exchanges is the timelines. So timelines to be aware of, you have a total of 180 days from the day you sell your rental property to to purchase your next property, and within that 180-day window, the first 45 days you have to identify up to 3 properties. If you fail to acquire one of those properties that you identify within that 180 days, you're most likely going to be subject to that capital gains tax. So just something to keep in mind is one of the downsides of the 1031 exchange. Additionally, there's something called basis erosion. I don't want to get too technical here, but when you sell your property using a 1031 exchange, the basis from your original property carries into and basically becomes your basis in your next property. There's some adjustments that go in there, but what happens over time if you continue using 1031 exchanges, you might end up with a property that's worth millions of dollars, but your tax basis is only a few $100,000. So if you were to sell that property without using a 1031 exchange, you would incur significant capital gains taxes. So there's just some things to be aware of there. 1031 exchange is definitely a powerful tool, but you just want to make sure you are aware of its pros, its cons, and like we talked about earlier in the presentation here, if you do have a substantial amount of passive losses, you might be able to forego the 1031 exchange and get a similar benefit. All right, so now we're gonna move into the step up in basis. So this is gonna kind of tie this all together. So when you pass down assets to your heirs inherit it at the fair market value at the date of your death, not your cost basis or your original purchase price. So kind of give an example of how powerful this is, right? If you were to 1031 exchange properties throughout your entire life, you're going to end up with a property, hopefully if you do this over decades, that's substantial in value relative to your tax basis, meaning if you sold it while you were alive, you're going to pay these massive taxes like we talked about before. But if you were to pass that to your heirs, they receive it at the fair market value at the date of your death, erasing all those taxes. So sometimes they call this swap till you drop or
Hmm.
1031 exchange until you die.
Hmm.
It's a little bit morbid, but that's what they call it. And this is definitely a powerful strategy. So if you can incorporate this into some or all of your assets, you are building generational wealth through real estate. So this is just another powerful strategy. This applies to other assets as well, not just real estate. But when you combine everything we just talked about here, you can see the power of real estate. Okay, so wrapping it all up, just to kind of tie together everything we talked about. Earned income from a job or a business taxed at high income rates up to 40 to 50% in some cases. Then you have rental income, which is also taxed as ordinary income up to 37% plus state taxes. However, it can be sheltered from tax thanks to depreciation. So there's no tax on your cash flow, and that reduces your effective tax rate, which is reducing your taxes. Really, that's what it is. Um, then you can tap into the equity of your property tax free without selling using cash out refinance because loan proceeds are not taxable. So it allows you to keep your property while getting money out tax free. You could also defer capital gains taxes when selling using the 1031 exchange or perhaps the lazy 1031 exchange if you have enough passive losses. So this keeps it efficient. 1031 exchanges, I didn't mention it before, is only available on real estate. So you can't 1031 exchange any other asset besides real estate. So it's exclusive right now to real estate. And then you could pass your properties onto your heirs at a step-up basis, eliminating all the capital gains taxes you would have paid. And this, in combination, all of this makes real estate one of the most tax-efficient asset classes that's in existence. Hope this helped everybody a little bit. But we're going to go ahead and move it to the next slide and pass it back to Leah.
Awesome. So if you are interested, I mean, as Thomas mentioned at the top of the call, I mean, this is Hall CPA's specialty, is advising their clients in how to plan accordingly to take advantage of these great benefits. So if you scan that QR code there, that is how you can get in touch with them to schedule a consultation and consider working with them. Of course, you could check out their website as well. Thomas, anything you want to add about kind of the services that you guys offer more broadly to investors like ours?
Yeah, yeah, absolutely. I would say what makes us different from a lot of the sea of CPAs out there is not only do we focus on real estate, real estate is our niche. We know the space inside and out, and we work with many investors across the board, but we also provide tax planning and tax strategy and planning services, which help you come up with strategic plans to reduce your taxes based on your situation and what your goals are. We basically help you develop the plans. Here's all the strategies that make sense for you, and here's how you have to apply them for your situation to capture these benefits. That is something that I think makes us stick out from a lot of other investors. We of course do offer tax preparation services as well, so we can prepare your tax return. I just got off the phone with a lender the other day who told us we had the most beautiful tax returns that she's ever seen. So that was her words, not mine. I thanked her for that. And then also, we also offer accounting services. So if you do find bookkeeping tedious, which bookkeeping is very important, do not underestimate bookkeeping. You definitely want to make sure you have clean books and records. Helps prevent you in the event of an audit, and also helps you make sure that you're capturing all of the tax deductions that you have on your property. So that's how we help real estate investors. So if you are interested or you are looking for a new CPA firm, we are in February right now. So now's the perfect time to start planning for 2025 and beyond. You have a whole bunch of time in the year to execute various tax strategies and plans. And if you don't have a CPA to file your 2024 tax returns, now is the time to have that conversation. You don't want to get too far into the year. We see people all the time who is like June or July still haven't locked in a CPA. You want to do that sooner rather than later.
Yeah, I think I was on a call with one of your associates a couple weeks ago, kind of talking about that because this seems to be, unfortunately, the trend is we're busy, right? And so people aren't thinking about the tax planning until they're staring down April, and then they're like trying to, find the right person, and then they're learning all the things they could have done but didn't. And
Yeah.
so this is something that's got to be kind of planned for. Like if there's no planning at this point that could happen on your 2024 year, but
Yeah.
you could start implementing some of the things you're learning from Hall for 2025 now.
Yeah, absolutely. There's a lot of things that have to be done throughout the year proactively. Once the year ends, like once the clock strikes 12/31, excuse me, January 1st of the
Yeah.
following year, a lot of stuff is set in stone, and there are some things you can do,
Hmm.
but you're limited in the amount of moves you can make. Additionally, one last thing I will say is that I just got off the phone with a real estate investor 2 days ago, and a potential client, and they told me that they wanted to use the short-term rental loophole we talked about before. But they made it one critical error in that they had a multi-unit property. They rented out two of them. I think it was two other units for as long-term rentals and the other one as a short-term rental. They wanted to use that strategy. The problem is when you have a multi-unit property, if you rent out several any of the units really as long-term rentals, it skews the average period of customer use on the building up beyond
Oh,
7 days and can blow out that entire strategy. Now, I was sitting there on the call with them and I was like, I really wish we would have had this conversation like a year ago because I could have told you, hey, if that's the way you want to go, don't do that. So
interesting.
the point I'm trying to make is sometimes there's things that you don't know and you
Hmm.
could be doing that maybe is nothing wrong with it, but could be jeopardizing your tax savings. So
Yeah, it's good. We don't know what we don't know. So it's good to be connected with people like you who think tax returns are beautiful, or your clients, no matter if that was you or an associate thinks tax returns are beautiful. But that is exactly why we want to work with professionals so they can help us prevent some of those missteps. That's good to know about the multifamily. Turning one unit into a short-term rental kind of negates your ability to utilize that short-term rental loophole. Man.
Yeah, yeah, because the way it works, the average period of customer use, when you dig down into the nitty-gritty of the tax code, it is determined basically based on the building's average period of customer use. So basically taking each unit and averaging more or less, averaging them together. So if you have a long-term rental where the average stay is 365 days,
Right.
that's going to skew the average stay so far beyond 7 or 30 in many cases that
Mhm.
it just kills the strategy.
Yeah. Well, good to know. Okay. Well, Thomas, oh, and Celia, our webinar producer, many of you may have noticed she threw the link into the chat. So for those of you who are on live, you've got the hyperlink there in the chat to connect with Hall CPA. So, Thomas, I know this is your favorite part of these classes. Do you have some time for Q&A?
Yes, yes, I do.
Okay, so we'll work our way through some of these questions here, and I'll try my best to read ahead and group some of the like questions so we're not hitting the same thing over and over again. I'll start with this. Alex, you ask about getting a recording of this. Yes, we are recording this webinar. The replay will go out to everyone who's registered for this call, and then we'll get it posted to our website so you can revisit it. Does Hall CPA service all states?
Yes, we have clients. Well, we have clients in 49 states. I think the only state we don't have is North Dakota, and there's no particular reason for that other than just happenstance. So we can when we do have the ability to service all 50 states, and we have at least done 49 at this point. So.
All right. Okay, this is a good question from Sandeep. We do have a fair amount of international investors, and in Sandeep's situation, looks like he's living in the U.S. on a H-1B or an immigrant visa. So his question is, do you have to be a citizen to maximize tax benefits? He was told something about 25,000 being the max limit.
So the max limit he's referring to in the $25,000 is the special loss allowance, which if you make under $100,000, you can deduct up to $25,000 of your rental losses against your income. I'm going to be honest with you. I don't know 100% about the H-1B visa's limitations in terms of working. There may be some limitations there. I'd have to look into it to verify that could limit the tax benefits. So, Sandeep, I could easily get you that answer. I don't know off the top of my head though, and I don't want to say something that might be wrong. So.
Yeah. And what about someone who is living overseas? Like I had an Australian investor the other day purchasing a property. How are the tax benefits different from them? Obviously, they might have implications in their home country, but anything different in the US that they should be mindful of?
So they're a foreign investor investing in the United States.
Yep, living in Australia, investing in the
Yeah.
United States.
Yeah, so you should be able to capture all the benefits at that point on the US side from being an investor on your US tax return. How that would impact your Australian tax returns, I don't know, but the US you should be able to set. You should be all good.
Great. Okay, Shelley asks if you can please explain accelerated depreciation methods. Want to touch on cost seg stuff?
Oh yes, I'm surprised I didn't touch on cost seg in this presentation. So um, there's something called, let me start here. So there's something called straight line depreciation. When you purchase a property, if it's a residential property, you're going to depreciate that property over 27 and a half years. So it's a little by little every year. But there's something called bonus depreciation. So bonus depreciation allows you to rapidly accelerate, in many cases, the depreciation on certain components of your property. So the components of your property that are specifically qualify for bonus depreciation are 5, 7, and 15-year property, which is tangible personal property. Think about like an appliance, some fixtures, land improvements, things like pool, sheds, decks, things of that nature. These all qualify for bonus depreciation. Bonus depreciation, the percentage, right? The percentage depends on the year. This year, it's 2025. There's 40% bonus depreciation under current law. So say, let me paint a picture of an example, and then I'll talk about a little bit about cost seg. So let's just say that let me go through cost seg first. I think this might make more sense. So the way you find out about the 5, 7, and 15-year property is by doing a cost segregation study. It's usually performed by a third party. There's software, do-it-yourself options out there. You can explore that. But what the cost segregation study does is it tells you, okay, great, you have your rental property, you have your house, and this percentage of your property is considered tangible personal property. This percentage is considered land improvements, and the remainder is considered 27 and a half year. You're also going to have land value. Land is never depreciated, so it's not going to be it's not going to be part of this cost seg calculation. But let's just say that you had a $500,000 property, $100,000 of that property's value was allocated to land, so that left you with $400,000 of depreciable property. You may do a cost seg study, and it's going to tell you somewhere between 20 to 30%, depending on the property, the location, so on and so forth, is going to be reallocated to that 5 and 15-year property, which is eligible for bonus depreciation. So in this example, let's just say that out of that $400,000, 25% is eligible. So that's $100,000. Bonus depreciation is going to allow you to take 40% of that this year in 2025. Again, 20, excuse me, as a depreciation expense. So that's $40,000 that is going to most likely in that first year not only eliminate your rental income, but also generate a substantial tax loss. So quick word on bonus depreciation. It used to be 100% from 2018 roughly to 2022. It was at 100%, which means you would be able to take the entire $100,000 as a deduction in that first year that was allocated to that 5, 7, and 15-year property. The new administration wants to bring that back, and they're currently having debates and talks in Congress about how that and many other provisions may or may not make it into tax legislation. But we tax professionals believe that it's a strong likelihood that it will make it back. So bonus depreciation, super powerful, allows you to rapidly accelerate depreciation expenses, and we hope 100% bonus depreciation returns.
Yes, me too. I hear rumors too that there's a possibility it could even be retroactively, like you could go back and, claim the full 100% for the years that you had the reduced amount too. Do you know anything about that?
Yeah, so there was actually a bill in 2024 that had it. It was passed by the House. It was rejected by the Senate, but in that bill, it included retroactive back to 2023, I believe it was. Right now, there's been no indication currently on how they want to treat that. If I'm going to get my personal opinion on it is that it's the more time they wait to pass that bill. And right now, it looks like it's going to be passed in the summer at the earliest, with September 30th kind of being that hard, kind of being the most viable point, like the last viable point it could be passed. If they wait that long, it's less likely they're going to make it retroactive. And the reason for that is because
More
it,
money.
it's that and also the administration or administrational hurdles of that, because by September most people have filed their tax returns, and they'd have to go back and be amended or perhaps caught up the next year. So I mean it is possible that that happens. I would say I find it unlikely to happen, but we'll have to wait and see. It'd be great if they did bring it back
Yeah,
retroactively.
I agree. So, on the topic of cost segregation, RealWealth has found a great cost segregation company that we recommend. They have an engineered study and a software based study. The software based study is very economical, in my opinion. It's a great value. And so, we have that listed up on our resources page. So, if you go to the Realty portal, click on resources up at the top, and you'll see the cost segregation company that we recommend. They're great. Okay, we knocked out a couple questions with that answer. Okay, let's do this one from Jeffrey. For passive depreciation losses to offset capital gain on the sale of a property, do the losses have to be from that same property, or can they be from other rental properties that you own?
It can be from other rental properties. But passive losses can offset from one property, can offset from another property. It's usually not a problem.
Great. Okay. Yep, that's the same question. Okay, if you are a real estate agent as your full-time profession and also a real estate investor, do you automatically qualify for rep status?
That's a good question. So this is getting a little bit into the nuances of the real estate professional status here. So there are seven, no, excuse me, there are 11 real property trades or businesses. Being a real estate agent or broker is one of them. So if you say worked 1,000 hours as an agent, that's your full-time job, you met the 750-hour requirement, and you spent more than 50% of your working time in a real estate business, you qualify as a real estate professional. But here's the thing. You still need to materially participate in your rental properties. So if you are a real estate professional, you're an agent, If you were to delegate all of it to a property manager, you never touch your properties, your losses on your rental properties, and you might be surprised to find, are still passive. However, if you met one of those material participation tests that I mentioned before, those three, um, spent more than 500 hours on your rental properties, which is most common because you can group your short-term rentals when you're a real estate professional as one, basically for tax purposes, or you do substantially everything yourself, or you spend 100 hours and more than anybody else, then at that point you would qualify. But if your only real to contrast that, if your only real property trader business was rentals, then you would have met that 500-hour test on your way to 750. But yeah, just to clarify, if you're an agent or you're fix and flipper, you're a wholesaler, you're a developer, and you're not actively involved or you're not materially participating rather in your rental activities, they still may be passive despite the fact that you are a real estate professional.
Hmm. Okay, good distinction there. Okay, so on the topic of real estate professional status, Rory asks if I can qualify as a rep, which I probably can. Could I use my Schedule E? Oh, wait, could my Schedule E losses offset taxable income from IRA or 401k distributions or other pension income?
Yes, yes. It cannot offset the penalties. It can offset the income that's generated as a result. One more thing I'll say on that, just to clarify, if you do become a real estate professional, you do have passive losses from prior years. They're not automatically unlocked when you become a real
Uh,
estate professional. Those will remain passive.
yeah.
Just in case anybody out there is wondering. But yeah, if you're a real estate professional in 2025, for example, you make a 401k distribution of 200K and now that gets added to your income as taxable income, which is taxed as ordinary income. You could use the losses from 2025 to offset that income.
Great. Okay, let's see here. Is short-term rental filled in Schedule C or Schedule E?
Short-term rentals are go on Schedule E. Is a big misconception unless you're providing substantial services. So if you're providing those daily cleaning, daily meals, concierge, at that point, that goes on Schedule C. And that was clarified within IRS publications, within the tax code and regulations, and in and of itself. But a lot of people get that, a lot of tax professionals get that confused.
Can't you really screw up the short-term rental loophole by offering some of those additional services? Doesn't that kind of jeopardize some of the savings there when you do that?
Oh, so when you provide those substantial services, you're now subject to the self-employment tax. So rental
Okay.
income, while it is taxed at ordinary income up to 37% in state taxes, it's generally not subject to the self-employment taxes. And the same is true for short-term rentals as long as you're not providing those substantial services. Once you start providing those substantial services, you're now squarely in this business
Business
category.
category,
Yeah.
right? Yeah, yeah.
So you could still take the losses from the property, but you're now subjecting yourself to that self-employment tax.
Yeah, that's good. So before you get all spooled up or excited about all these add-on services that you might be able to offer to boost revenue, know how that might implicate you in other ways.
Yeah.
Okay. So Nick's question is, I have a W-2, a side active business, and passive rental properties. Go, Nick. When I move money from active business to rental property, it counts as a distribution. Would it be better for me to reinvest that money in active business to get bonus depreciation?
Okay. So, what? Yeah. So this is a complicated question. There's a lot of things that could be going on here. So, W-2, active side business, passive rental properties, and distributions. Okay. So, um, if you have an active business that you're running, it depends on the business, right? If you reinvested in a business where it's equipment heavy and you have a lot of like tangible property that's like 5 years. So, say example, your business was, I'm just going to give a few different examples. Say you ran Toro car rentals, right? And you're actively involved in that. Reinvesting that money into that type of business into another car could give you additional depreciation deductions because you're buying fixed assets like cars. Another example of that might be if you're a physician, where you're a doctor. That's probably not your side business, but it, be deducting your equipment, or maybe you have a pizzeria and you deduct the stove. I'm just trying to give some examples there of how that could work. It just depends on the type of business you're running to answer your question.
Okay. Okay. Mayank asks, I'm qualifying as a real estate professional based on the short-term rental loophole. We'll clarify that statement. I mean, you're not necessarily qualifying as a real estate professional. You are leveraging the short-term rental loophole. His question is, will all of my capital losses generated during the year of 2024, mainly from my other rental real estate, be offset against my W-2 income?
Um, so with the short-term rental loophole, it only applies to your short-term rentals. So
Mm.
if your other properties are long-term rentals or mid-term rentals, those will still be passive unless you qualify as a real estate professional.
Yep, that's the distinction, Mayank, that I was trying to make. The short-term rental loophole does not make you a real estate professional, where now your all of your real estate, is in this looked at by the IRS in this different manner. It's just that short-term rental that is eligible for that loophole savings.
Yeah.
Okay, let's do this one. Aziz asks, can you take passive losses from one real estate investment and not from the other properties, or is it all or nothing?
Um, if you have passive losses, is take them. I guess it depends on what you mean by take them, like use the deductions. If they're eligible to be used, they will be used. So if you have rental income or you have a capital gain from the sale of a rental property and you do have passive losses that can be used, they will be used. Yeah,
Hmm.
there's no picking and choosing there, unfortunately.
Hmm. And then any excess can be carried forward to the following years.
Correct.
Okay, Rosina asked a question about HELOCs. If you take the HELOC on a property, does that decrease your equity for capital gains purposes, or it has nothing to do with your basis?
Does not impact your basis.
All right, let me scan for another good one here. I try to, just so our viewers know, I try to look for the questions who have some general benefit to the group. So if they're too specific on your situation, I'm not ignoring you. I want to benefit everybody who's watching. Um, is there a tax benefit in investing in real estate through an incorporation or establishing a corporation?
Um, no, in fact, you want to avoid corporations for rental properties. I just tell you why right now. So hopefully it's not just someone saying don't do it. If you put your property in an S corporation, for example, which is the common corporation we end up seeing people put rental properties in for usually at the recommendation of their attorney, is when if you ever need to remove that property, so say estate planning purposes, you're restructuring, or perhaps your lender says, "Hey, we won't lend to this unless it's its own LLC or standalone entity or something along those lines," and you remove it, it triggers a sale. So it's even if you're just moving it to another entity that you own. So that sale could trigger capital gains taxes for you. So you want to keep your rental properties generally in LLCs that are disregarded for tax purposes, like a single member LLC or an LLC is taxed as a partnership or a combination thereof. You want to avoid corporations for rental real estate.
All right, well said. I know that I've heard of horror stories of people getting themselves in binds, setting up corporations they didn't need. Okay, Roy asked this question. Can I use bonus depreciation in one rental property to offset rental real estate capital gains on another?
Yes. Yes, that's the lazy 1031 exchange right there.
Oh, that's funny that it's called a lazy 1031. I had someone use that the other day and I was like, I was uncertain how to answer. I'm like, I don't know if that's something more formal or if that's just one of these cute coined
It's
names
it,
that
it's just the cute name. Yeah.
Okay. Um, Thomas, I want to be respectful of your time. Thank you so much for taking a mass blast of questions there. This was really informative and inspiring for me as an investor. I mean, I love really seeing the benefit of building a portfolio long term and how it can serve us for the long term, not just in creating wealth, but also reducing the amount that we have to give away to someone else. So, Thomas, thank you so much for being here today. Again, to our listeners who are watching, reach out to Hall CPA if you are interested in working with them or getting some additional strategy advice on your specific situation.
All right. Thanks for having me.